Since today's Fed Day, we're going to tackle what our next guest calls the bubble of modern banking and what investors can do about it. Author, founder, and editor of Grant's Interest Rate Observer, Jim Grant, joining us. Jim, always glad to see you. Welcome back to Money Move. So today is Fed Day. Most people say unless Ben Bernanke himself goes for QE3, it is not going to happen. But this doesn't change the overall environment. What is an investor to do? Cry, drink, go home?
Drinking helps, but not during business hours.
That's right.
To begin with, perhaps we should introduce some mental hygiene into this Fed announcement. The Fed will say almost certainly that it remains highly accommodative. In place of the phrase highly accommodative, mentally insert the phrase highly manipulative.
Okay.
What the Fed is about these days is the manipulation of interest rates. They have some fancy phrases for these. They call money printing quantitative easing. They want to lift up asset prices to help us, civilians, take a friendlier attitude towards the world and thereby help the macroeconomy improve. That's the theory.
That's the theory.
But notice, it's not their money they want to invest in. It's our money. As for what investors ought to do, as always, they ought to insist on a margin of safety and buy low and sell high. Am I making sense?
Yeah, of course, yeah. Common sense is not so common, as you say. But what happens, Jim? I mean, as you have pointed out, this has been extremely disrupting. I know you've even talked about creative destruction and the fact that the Fed is actually impeding the natural forces of capitalism.
Yes, the Fed seems bent on suppressing this most elegant thing we have called the price mechanism. The movement of prices determine all manner of things in a market economy, yet the Fed seems bound and determined to superimpose its will in place of the price mechanism. Take the bond market, for example. The Fed has hammered down yields directly and indirectly, and in response, people are throwing money at things like high yield or junk bonds. The inflows into mutual funds owning junk bonds are like 3 or 4 times what they were all of last year already. Yields on these speculative grade securities have fallen, the prices have risen. It feels great, but we're not sure. We can't be sure that these are the right prices. The prices the Fed wants, but are they the right prices? No, not necessarily.
Jim, getting down to brass tacks, how is a bond investor to deal with this current environment? You're calling actually for a bear market, am I correct?
And have forever. So I'm no help there. But it seems to me that a bond investor is almost better off in cash. If you were to go out 10 years in a U.S. Treasury security, you're earning approximately 2%, right? To remain in cash and be flexible, you're sacrificing those 2 percentage points a year. But you are not part of the herd that is being...
I read in your newsletter, if we go to the movies and we spend the money ourselves, it's almost the same, right, over a 20-year period.
Yeah, the bond market is a desert of value. There's simply nothing there. And yet, because it has gone up, because the Fed wants it to go up more, it is beloved by the professional investors. Somebody was quoted in Bloomberg story just the other day as saying, one of these $1 trillion plus bond investors saying that he personally would not invest in securities yielding less than 2.25% per annum, because that's not really a value proposition. Less than 2.25%, more than, so he's going to wait until back to the 10-year gets back to 2.25% from 2.
Right, right.
That ain't value as the ancients determined it, right?
What does this mean for gold? I know you've written about gold being the trade of the weary, not necessarily the trade of the frightened. Do you still see it that way?
To me, the price of gold is, as it were, the reciprocal of the world's faith in the deeds and words of the likes of Ben Bernanke. The world over, central banks are printing money as it has really never been printed before. The European Central Bank, over the past 3 months, has increased the size of its assets, its balance sheet, at the annual rate of 89%. 89%, Deidre. Look amazed. It's astonishing. and the Fed is far behind the bank. It's only at 15% over the past. The Bank of England is 67% over the past 3 months. These are rates of increase in the production of paper currencies really never seen in the modern age.
I was just going to say, yeah, no one's seen these levels.
And you know how they do it?
Go ahead, Jim.
It takes no effort at all. They simply tap the computer screen. So, we now all understand the meaning of the phrase quantitative easing, but many of us are left wondering the meaning of the word money.
We are back now with Jim Grant from Grant's Interest Rate Observer. Jim, we've been talking about the Fed. We've been talking about gold. The two pretty much linked together. We just heard from Alex Steele as well from that metals conference. What would be your ideal read? What would you like to see in the Fed's minutes today? Yes.
In the press release. Here's what I'd like to see. This is my dream.
What should happen, yes.
The announcement of the formation of the Federal Reserve's Office of Unintended Consequences.
Okay.
That would tell me that at long last the Fed conceded that the results of a radical policy measure, and believe me, these are radical policy measures, the results might not be in accord with the intentions. The most interesting
because right now it sounds like you feel like there's no awareness of that.
There's no knowledge awareness. These are Ben Bernanke is a spelling champion of South Carolina, and these are smart people. I think they know it, but it would help me, and I dare say it would help many people feel more comfortable with this program if they would acknowledge it in public. Yes, the Office of Unintended Consequences will study what we don't think is going to happen, because that's what's going to happen.
Not to defend the Fed, because I'm sure they can themselves, but maybe I know, for example, during the crisis, they have said, look, these are extraordinary times, extraordinary measures are needed.
It's been 4 years.
Okay. I mean, time to move on.
The patient is over-medicated, in my opinion. They keep on dosing us collectively with these measures as they call them, repress financial to stimulate, to manipulate. Enough. How about the price mechanism? How about capitalism, Ben Bernanke?
How about capitalism? What's the worst case scenario, though, Jim?
Don't ask.
Don't ask. Okay.
Well, the worst case scenario, I think, is when the collective actions of the world's central banks simply careen out of control. I mean, these exercises in money printing and credit creation are titanic. And it might be that it works out. It might just be, because we don't know the future, that we'll look back and say, my goodness, Ben Bernanke, he deserved his PhD. What a smart fellow he was, and what a dope Grant was.
Better to be lucky than good. We all know that.
But there is surely a non-trivial chance. And by the way, Warren Buffett does not acknowledge there's a non-trivial chance of this all going wrong. But that's why people own gold, because there is a non-zero probability of these actions spinning out of control.
And Jim, you've been looking at the performance of gold versus the performance of commodities. We even actually have some charts made up which show over the past year commodities have outperformed stocks.
Well, this is all apropos of the latest Berkshire Hathaway annual report, in which Warren Buffett kind of smirks at gold and says, it really doesn't yield much. It's for the fearful. But we went back and we looked at the performance of gold and the humblest thing, sugar, a cup of sugar, and Coca-Cola Common since 1996. And wouldn't you know,
there's the chart right on the screen. So we have gold outperforming clearly in yellow, sugar right in the middle.
It's humiliating to the people who own common. But this is what happens. This is why evaluation is so important. It's why price and a margin of safety is so important. In 1996, Coke was at whatever 39 times earnings or something, and gold was known to be the refuge of not the fearful, but of the idiots.
But as Ms. Rifkin likes to point out, right? Buffett's biographer, he likes to brag that he has made most of his money sitting down.
Right. And to be sure, I don't fault Mr. Buffett as an investor. It would hardly behoove me to do so. But I do observe that over these past not so prosperous dozen or so or more years, the commodities have done better than even the best quality equities. Again, emphasizing or underscoring the point about valuation. So stocks have been in the wilderness for 10 or 12 years. That doesn't speak badly of stocks. On the contrary, it suggests we ought to take a closer look at some of them. Coke now is at 17 times earnings. It yields more or as much as the 30-year bond. They earn fabulous margins, always have. They've got these products that bring in more than $1 billion a year. So Coke's okay now. It was not okay in 1996 when everyone was saying, oh, Coke. Yeah, you got to Coke.
All right, well, you're taking on some heavy hitters, Mr. Grant, but familiar territory for you. Speaking of heavy hitters and commodities, not a person, but a country. I know you've also written that you're quite concerned, like a lot of people, a lot of investors, with the lending that's going on in China and what seems to be at least a crack in the system as far as their real estate goes.
We're quite bearish on China, quite bearish on the real estate situation in China, and in general, wary of the consequences of an unscripted Chinese slump on the world of things, from iron ore to, you name it. China is the great big marginal bid. And people think that somehow the Chinese have figured it out, that they know how to pull the levers and twist the dials such that they deliver 8 to 10% per year, world without end. They don't.
Right.
This is a command and control regime. The only thing certain about China this year is the Communist Party will win in a landslide come October.
That's the one sure thing.
Yeah, I'm sure.
But in the meantime, I mean, you've pointed out that if some of the debt is out there and is bad, it could equal, I mean, about $1 trillion.
Yeah. I mean,
and the GDP is $7.5 trillion. So that's a pretty heavy percentage.
I'll tell you how bad the Chinese banking system is. The Chinese banking system is worse than the Texas S&L business in the 1980s. That's how bad it is. Actually,
I thought you were going to make a much more unfavorable comparison to our current system, so I'm glad it's just Texas and S&L.
China is as bad as the city of New York's banks were in 2007. That's how bad China is.
Okay, well, that's a pretty clear statement, Jim Grant. Always great to see you.
Thank you, Deirdre.
Thank you for coming. Jim Grant joining us here on Money Moves.